Hi, this is your host, Andrew Raffel, the founder and CEO of Baintree Wealth Advisors. And I wanted to personally welcome you to Your Wealth and Beyond, a podcast that will empower you, the entrepreneur and business owner, with the insight and information you need to effectively manage and control your personal and professional finances. My goal is to help each of you get your fiscal house in order so that you can take your business to the next level. I'm going to help you focus on growing your business, building your wealth, and most importantly, finding purpose in what matters most. Welcome, everybody, to another episode of Your Wealth and Beyond, the podcast built to help you, the entrepreneur, build your business and find purpose. And today we are very excited to have on Kevin Fechtmeyer, who is not only a friend, but somebody I respect greatly in the financial and private equity business. Kevin is the founder and managing partner of Cave Creek Capital. He's got well over 25 years experience in the private equity business, and him and his firm has helped funded more than 30 platforms company with more than $1 billion of equity and has completed hundreds of acquisitions during his career. So it is great to have you on board today, Kevin. How are you this fine day?
Great. Thank you, Andrew.
And as you guys, listeners out there know, Your Wealth and Beyond is about helping to shape and build your business. And one of the questions that we all get is, how do I fund my business from the initial startup into the different phases of the growth of the company? And today we're going to learn quite a bit from Kevin, his experiences, his background, and it's going to help you, the business owner, kind of gauge out where you are. And we're going to have a lot of good tips and strategies in how to take it to the next level. So Kevin, before we jump in, can you give us a little background on who you are and how you got started years ago on this side of the business, and some of your passions of helping these businesses grow from maybe medium to large companies?
Oh, sure. Would be happy to. We've got, I guess, about 50 minutes left. I'll try to not consume too much of that time because obviously I want to go through some of the questions you had mentioned in earlier discussion about different kinds of entrepreneurs and how they got to be successful. But I'll try to minimize the time on myself. But my initial grounding was in public accounting. I started as a CPA at 2 Schross way back in the 1980s, and went to business school for about 2 years until 1989, and Columbia Business School. Then went to Wall Street. At that point, worked for some big firms, first Boston, Merrill Lynch, and kind of made the decision at that point to just focus on smaller companies. I didn't want my tombstone to read, "Gee, I saved General Motors 35 basis points." That wasn't going to be my life goal. These guys were very smart, very successful, a lot of fun to talk to, but they were clearly doing bigger deals, $1 billion kind of deals, and there was 20 people on a deal team, and your impact as a person in the financial world was pretty limited. Venture capital and private equity were just getting going back then, and at that time I teamed up with a partner of mine who ran Goldman Sachs private equity placement group, and then we brought on another partner from Drexel. He and I, really the three of us, started at that point what became the leading private equity placement group on Wall Street. Over the next 7 years, we completed about $1 billion of placements. He had a lot of interesting background in deals that people had never heard of until now. And back then, nobody had ever heard of Dell Computer. Nobody had ever heard of Qualcomm. And these were companies that then went on to become major companies in their own right. So I knew that it would be a lot more exciting in my career to focus on growing companies. And it became really kind of a 25-year passion to begin my own business and help companies like that raise capital and grow and develop their infrastructure, which is no small task. As you may know, only about 10% of the companies make it from $10 million in revenue to $100 million of revenue. So there's a very high mortality rate. And the quality of your capital partner and the quality of the management and a lot of things go into making that a success or not. So going back to my background in 1996, we began a boutique that was focused on raising capital and also making investments. And we were quite successful there as well. Did companies like Hickory Farms and HQ Office Suites and here locally in Arizona, Peter Piper Pizza. And in 2003, I decided to move my family back to Arizona where we could base our business. And 12 of our CEOs backed me and what became Cave Creek Capital, which is really an extension of our co-investment activities on Wall Street. And in that time, we have now in the last, since 2005, when we closed our first deal at Cape Creek Capital, we've closed over $1 billion of transactions and 14 different transactions and 9 different platform companies. So it's been quite successful since then.
Incredible success. And, that's an incredible success story. When you look back to working on Wall Street in the late 80s and 90s, were you then in the midst of with the junk bonds and the financing there, obviously working with Drexel? Was that something for you on that tail end of some of the collapses there? Did that help to shape your vision of where you wanted private equity and venture capital to be?
No, that particular time actually was not the seminal moment of change for private equity. It was really 2001, when the bubble burst and the internet came in. It actually had the effect of commoditizing the agency role, which everyone could then go on the internet and find out who was handing money out or not. And in addition, it began the mushrooming growth of the capital available in the market. So we went, in terms of total capital allocated to the industry, over 20 times growth from the 1990s to today. So it became a very different business after the 2001 stock market crash and the internet bubble collapse. And that's affected, frankly, all the way through today.
So let's look at things for the listener, because we've got business owners that are in the infancy of their companies and then business owners that have been building it and growing the revenues and building a business that down the road is going to be scalable and potentially sellable. So, walk through the listener. What is some of the value in potentially partnering with a private equity firm or venture capital? And is that something that every firm should have the goal to eventually bring into the equation?
No, not necessarily. A lot of companies are just fine staying their own size and growing at a modest rate. And some of them are owned by business owners that are very happy to have a lifestyle business. They've got a good business that is providing a good income for their family and their partners. And so I would argue that, in fact, only a minority of companies should really feel like they need private equity. And frankly, a very small percentage of them would be able to raise private equity. It's actually something for companies that really want to think about growing to the next level and reaching 50, 100, or 200 million of revenue. At that point, then I think it becomes very important to have that institutional background and the board and everything that comes along with private equity.
So in the beginning stages then, with a lot of small businesses that, may have, like you said, lifestyle practice, they have good margins, they may be bringing less than 5 million of revenue. But as they're getting started with the infancy of a company and trying to build it out, then what would you say is the best way for that type of business owner to try to achieve their growth, and how would they raise capital? Would it be looking at things then more on a debt side versus an equity side?
Well, everyone's different and every business is different, but the pattern that we typically see in our businesses, and our businesses are middle of the road consumer companies, manufacturers, business services, but the pattern is pretty consistent. They start with their own capital. They occasionally bring in a partner or two, could be family, could be friends, and they grow and validate their concept. And that usually can be 2 million, it can be 5 million, it can be 10 million of revenue. At some point, the customer speaks. And at that point, the company may grow beyond the pocketbook of the owner. So then what do? You end up looking around, and oftentimes a bank comes in. And we don't have to tell you that the banks are quite conservative relative to what an entrepreneurial capital need would be. So the bank only gets you so far as well. So we typically see a company that's getting to 10 or 20 million of revenue, and profits are growing, but they're not enough to fund a growing business. And the bank is limited based on their credit underwriting guidelines. So you have to look outside. Oftentimes these guys are on the hook for personal guarantees. Their home's on the line. A whole host of different things can tie you up and actually make you more conservative as a business person. So what happens is you end up with you grow slower because you don't want to lose your house. It's much easier not to add another few people than to add another few people and risk growing payroll. And
And do you see that then in most of the infancy, the beginning stages of the businesses, that most of it is tied to, for the entrepreneur, the personal guarantee? They're going to have some collateral, whether it be personal or on the business assets.
that's a big part of it, but not the only part of it. It can be just your bandwidth. You can only manage so many people. You can only develop talent and manage so many customer relationships. So a lot of it's about having the courage to delegate. A lot of companies plateau. And sometimes they plateau with just the founder as the driving force, and sometimes they plateau with a small team, but they plateau. And you'll see that in the numbers. So the growth will level off, and they'll have to create new engines for growth. And that's hard to do within a small company with limited resources. So that's also where private equity gets called in and can provide, additional capital and human capital as well at the board level to help access new customers and grow to new markets and expand through an acquisition, a whole host of things that you need to grow.
And, I think with entrepreneurs, a lot of us are really good in the beginning stages of a business. When we're running, it's visionary, it's getting what we fully believe in and getting it out to market. And then as you start having the success, what I've seen working with business owners as they get bigger and bigger is that the entrepreneur either has to make the conscious effort that they can't do it all, and they're going to have to bring in people that they trust that maybe can run the business better and let them focus more on the grandeur vision. But have you seen that the entrepreneur that doesn't let go, is that where some of that stunting the growth happens, because they're still micromanaging and they're not letting the right people come in and take it to the next level?
Yeah, those are pretty common problems, and not always intentional, by the way. A lot of people try to hire and try to grow. And even in the best of circumstances, you'll get a 50% success rate. It's really, really hard to get the right people, the right talent, the right culture, the right fit. So that's another way that a good board and a good private equity sponsor can help maximize the chance of a good hire and minimize the chance of a bad hire. But you're right, there are cultures in which the founder then sort of becomes the sole decision maker. And it's very, very hard to attract talent then. And it's very hard to create an environment for growth because they're literally controlling every decision. That's a tough situation to be in, because as one of my entrepreneurs called it, that's when you've created a cult, not a culture. And you got to be real careful with that.
And when we look at the term angel investors, that, a lot of the listeners out there maybe have gone down that path. Some have just heard of the term, but what does that actually mean for a business owner? What type of investor is that? And at what stage of the game would we look at, bringing on maybe an angel investor?
Well, it's interesting. It's always an interesting name, angel groups, angel investor. And I think they've acquired their own definition, legitimate definition, but I think it was started because they wanted to make rich people feel good, because it's like, oh, I'm an angel. I would argue that it's just any high net worth individual that whether it's you loaning $100,000 to your nephew to start a Denny's or a McDonald's, or it's something else. It can be $5,000 for your college graduate to start a side business, because this whole thing about putting something online, it resonates with you. But it's almost like pre-venture capital. It's before even an institution can get comfortable. An angel is taking a much larger risk. Oftentimes they're successful in their 50s, and yet they don't want to sell. And a lot of people think, oh, gee, I have to sell, but that's not the case. There's a lot of structures, particularly, we've begun to specialize in structures where the owner can take, half their money off the table and then keep running the company, and double, triple, quadruple, or more the other half. So they kind of get to have their cake and eat it too. And a lot of them drives them to that decision is the desire to, save for their kids' education or buy a house or help their son start a new business or help their daughter start a new business. And it can be anything in life that causes them to take a deep breath and reconsider. It could be health issues, could be family issues. And they're saying, boy, I don't want to sell, but I need some chips off the table that, help me sleep at night and take my personal guarantee off and know that I've got someone to talk to. But how do I do that if I don't want to sell? And then that's really where we come in. That's where a process usually starts, a small process where they begin talking to us or maybe a couple of people like us to see if there's a way they can structure a tailored solution to meet all of those needs. And because we're structured as a family office, more so than an institution, we can do that. We can tailor part debt, part equity. We can stretch it out 5 or 10 years. There's a lot of different things you can do as a private equity investor when you're focused on the entrepreneur and you're not hamstrung by traditional 10-year blind pool fund structures.
Right. And I think there's an emotional side of this too, where the business owner, the entrepreneur, they've been running, they've been going, they've been building, and they own 100%. And letting go of that is an emotional side that you have to deal with. But in anything, when we're properly planning to have that diversification, to have not only the ability to take some chips off the table, but now have a partnership of being able to have, outside counsel to help grow. It's one of those areas that I think any entrepreneur should strive for. And your business is as good as it is today, but we just don't know where it will be in 3 years and 5 years and 10 years. What if the industry changes that you're in? If there's tax laws that change, if there's another recession, if there's things that are out of your control, if you have the opportunity to diversify and take some risk off of your shoulders, I think it's definitely something that you should look at and make that conscious decision that you're okay with owning a little bit less. Sleep well at night, we call it, right, Kevin?
Yeah. No, and a partnership is a good thing in many respects, in ways the entrepreneur can't even envision. A lot of our founders breathe a big sigh of relief after closing when they find out they have a board to talk to. They've got millions of dollars in the bank. They've got even more upside in front of them. And then when something complicated, an issue arises that they used to have to deal on their own, now they got 2 or 3 smart people on their side to talk about it with and to solve. It's a big relief for most entrepreneurs.
Yep, I definitely agree.
The angel investor is really pre-venture capital. It's one of those categories which is ill-defined. It can be your rich uncle, it can be a friend, it can be anyone who is willing to take a far greater risk than a traditional institution. And some angel networks are pretty well formed in certain cities. They've got seasoned executives that are helping little companies grow, helping them get started. It's a very undefined area, but it's actually pretty valuable for certain companies, particularly in the technology field. I generally see angel capital as really friends and relatives in the kind of businesses I see. But if it's a formal angel network, you can get a lot more than just money from those networks.
So, when you think about an angel investor, then I wouldn't call it necessarily all dumb money, right? But is it usually, where you guys as private equity and venture capital take a hands-on approach? What kind of approach does an angel investor take with helping to shape the business, if anything?
They can take anything from an executive in residence role where they actually sit in the company's headquarters and actually perform part-time executive duties, which I've seen before, to just literally being available for a phone call once a month. But angels generally size their involvement to the needs of the company, ideally.
And so when we look at the percentage of success on the initial stage in angel investors, percentage-wise, what would you say if I'm an angel investor, what's the percentage of me actually getting a return on my money with the business that's in its infancy?
Yeah, very hard to say. And oftentimes it takes 5 or 10 years to find out. But, I've heard one angel group locally has made 24 investments and 1 or 2 might work out. And those are pretty well vetted. Those are out of probably hundreds that they review.
And so on the angel investor side, you're looking at businesses that they're not mature. Their revenues are probably, what would you say with regards to is it more like a startup then in the case of where an angel investor would come into play?
Oh, yeah. The startup or less than $1 million in revenue.
Okay. So if I'm a business and I'm out there and I look at, okay, I've got this idea, I need capital. I really have 2 routes to go, right? The debt side, which is try to go deal with the banks, whether it be the large banks or the local banks, or the private investor, the family and the friends. Would you say that's really the 2 main outlets for a business that's starting up that doesn't maybe have the track record, et cetera?
Yes, based on what I've seen. But I would argue that the most important capital component is the labor of the founder, the labor of the entrepreneur, who's generally working for free. It's their passion, their vision that really drives the first year or 2 of a business and determines whether they're going to be able to attract outside capital.
Working for free, I like that. I mean, it's like, if you think about the hours that an entrepreneur puts in, even if they're showing some net income, right? at the end of the day, they're probably working for less than minimum wage, if not making anything. So I thought that's an interesting point there of working for free. And sometimes, you look at your employees and they don't realize how much work goes in and the risk that an entrepreneur is taking. And it's one of those that until they're in that position, I don't think an actual employee is going to know the type of pressure and the hats and all of the different fundamentals that the entrepreneur has. And that's something that I don't think any book or anything you can find that from that. It's actually the experience itself.
Well, yeah, it depends on the employee, but certainly they all have an awareness when they come to a young company that they're taking a risk. And some people that have vibrant careers elsewhere could probably go anywhere, but they take that risk because they think there's value in the equity, that there's some potential equity participation going forward. And if you join a little company called Facebook or Google, it can pay off great. But if you pick the wrong one, you can end up with nothing. So the employee is taking a risk often as well. And oftentimes they're taking cuts in salary to go there.
Right, with the potential of that home run or that lottery type of award.
Correct.
So we're not going to give tax advice here at all, but when you think of the formation of a company, a lot of times it's the initial entrepreneur. He's starting it either as a sole proprietorship or he's incorporating as an LLC. But if you were to talk to the business owner that had the growth mindset, the grandeur vision to build this thing to get to the point of the 10 million in revenue, then the 20 and up to 50 and 100, do you see companies building the structure differently than those that are more of the lifestyle practice in how they form the company?
It all depends. Most of the companies we see are sub S or LLC, and there's some real restrictions on sub S's. But the LLC is a very flexible structure. We invest through LLCs. C Corps, if obviously for profitable companies, aren't the most efficient way to go. So I think that you have to look at each company individually. And we've actually invested in companies that had subsidiaries that were all three, LLC, sub S, and C Corp. And we've combined them in a creative way to maximize or optimize the tax situation for the founders.
And where your value also comes in is, as we don't know where tax reform's going at this point. Obviously, it's going to be a battle. And to the end of the day, until it's figured out, we on our financial planning side and our tax side, we're telling clients, hey, let's not even focus on anything right now. Let's let things shake out. But if and when they do make some changes, will you go in to the companies that you invest in, that you've partnered in? Do you guys come in and take a high level view? And will you change some structuring based on if Congress is able to get some things pushed through?
I don't think we're going to be doing a lot of changes. There may be one or two small changes we would make, but LLC pass-through entities are pretty flexible and will accommodate any tax regime that comes down the road. A lot of the drivers for our company's success is the growth and the human capital that we can attract. And a tax law change generally doesn't change the prospects of the business. It may change some things that we do in the future, but right now there's very little that we're going to do retroactively because we've got a pretty flexible structure to begin with.
So you would say when you look at what the success of a company, the human capital, because you hit on that a couple of times, that is the human capital of a company is something that really helps separate companies that make it and those that don't?
Oh, that's no question. The common phrase you'll hear from private equity investors is rather have a B company with an A management team than an A company with a B management team. So investors focus on people, and they are the drivers of value and the culture that they develop and the kind of culture they attract. And we've had a lot of experience over 25 years, and we've been fortunate enough in most cases to pick industry leaders, and they become what we call the talent magnets. So they can attract tremendous talent that even the larger companies couldn't attract. That's been a differentiator for us in almost every investment.
So when you look at the deals that you've done over the years, what are some of the things that Cave Creek Capital Management looks for when you're kicking the tires and deciding if you want to go on this venture with this firm, whether it be short term or longer term? Talk us through some of the key points and what you and other private equity firms look for as an investment strategy.
Boy, that's an hour-long discussion right there, but let me boil it down to maybe some of the handful of key points. I think we look at, obviously, the talent management, which we've talked about before, the quality and their ability to grow the company and attract other similarly talented people. We look at the overall market and what is the competitive environment. You want to pick areas that have a competitive advantage for the company that you're investing in, or at least some barriers to entry. And generally, when we've looked around, people in the past have said, boy, how do you invest in executive office suites? How do you invest in candy distribution? There's no barriers to entry. Well, if you look hard enough and you really dive into businesses like that, you find that they do 100 little things right. So the barriers, the things that we look at is a market where for a middle market investor like us, a $20 to $100 million company can be a leader. Those are generally pretty fragmented markets. They're smaller markets in the US that are, not attracting huge competitors that have significant cost advantages. So we found that, for instance, companies like the candy distributor, they do 100 little things right and they become a cost leader. Nobody could do things more efficiently in that market than we did, that we saw in Liberty Distribution, which was one of our investments about 8 years ago. Similarly, in the culture that was formed at HQ Office Suites, we found that they were attracting the very best managers. This is going back 15 years ago, where the industry began to consolidate and the better centers were attracting the better managers, and they were keeping clients longer and servicing them better and getting better margins. So the reputation of somebody in the market as a talent magnet becomes a critical competitive advantage. And we've done that in many cases.
When you look at HQ, right, and they were able to attract that talent and keep it, what do you think they did differently than other firms in other industries to keep that talent?
Well, they kind of redefined the business. And this is a lot of the theme of our investing is we like businesses that didn't exist 20 years ago. And executive office suites essentially didn't exist 20 years before we had done that deal. They were temporary office space, and they sort of recruited somebody, an office administrator from somewhere, to just keep track of the offices and maybe do some of the administrative work. And what HQ did under their chairman, David Veal at the time, was go out and overhire. They would buy tremendous benefits by paying an extra 20 or 50% or creating a commission system for the manager to be rewarded by keeping clients longer and adding revenues and services. So if you look at that, they changed the rules of the game. They were hiring out of the Marriott Management Training Program. They were hiring serious people with serious backgrounds. And they were, in some cases, doubling the revenue of the centers after they bought them by filling them up and creating more services. That was just something people had never done before. They didn't think about it. So by being first and building that reputation, they became the leader.
And like a company like that, this is years ago when you guys, put in the capital, but is a company like that looking for you, or are you looking for these companies to invest in?
It's really both ways. And this, again, goes back to the two-way street. Today, there's 10 times more investors calling companies than there used to be. But I liken it to what Monster.com and LinkedIn have done to the job market. Employers, like companies, can get thousands of resumes. And it's harder than ever. Back when you had to mail it, lick the stamp, and send it in, you got 10 or 20 resumes, and it was easy to sort. How does a company sort through 100 or 500 options? That's what the capital markets have become like in private equity. They're almost impossible to really distinguish. And so what's happened is you've got to have a much more sophisticated way of determining what the capital needs are on both sides, both the company and the provider. In the case of HQ, they were initially coming to us through a referral from Goldman Sachs that it was too small for the Goldman private equity effort, and they were looking for, I think, $3 million, and we convinced them they might need $5 million. And then it became $8 million. And then we started talking about the opportunities to consolidate the industry, and they had not thought about that before. And then it turned out that as we were doing our due diligence, we found another company with 20 locations and needed to do something because one of the founders was looking to sell. So we ended up going from 3 to 5 million to 8 million to what ended up being about $32 million on the original closing, and tripled the size of the company from what they had even envisioned themselves. So that dialogue created a wider mindset. We call it our supercharged model. And it turned out to be more than supercharged. They went on to complete over $150 million of acquisitions, closing one every month for 36 months, and then ended up recapitalizing and selling in a transaction with a Blackstone-based company about 4 years later.
And then with that, you guys exited out of it at that point?
We exited out of about 70% of our shares and left in about 25 to 30%. I don't recall the exact split, but the majority of the dollars were returned, and it represented almost an eightfold return on our capital.
And, you look back at how they went from point A to Z. They were doing something right without you, right? But the guidance that your firm and the other partners that came to the table, I would assume that helped shape their vision and gave them the confidence and the wherewithal to say, okay, we can do this. And then having that team approach really allowed everyone to set these goals and then to take it to the next level and bring the right people in. And that's something that companies can't do on their own. The banks aren't going to do that for you, right? The banks are not going to be your partner. That's where the private equity comes into play, and getting into bed with both sides. I think one of the things that you probably have to look at is beyond the numbers, right? It's, do we like this management team, right? Do we want to work with them?
Yeah, and that's exactly correct. It was a good chemistry, good board, terrific investment group, and things just worked well in that team, and it enabled them to become the leader in the industry quite rapidly. But before we pat ourselves on the back too much, they had to fight off a lot of competition. Within 18 months, there were a number of copycats, and the industry consolidation accelerated, valuations increased. So, you can become a victim of your own success, particularly if you don't move quickly enough to capitalize on it. And that capital partner can get you there a lot faster. And then that in itself creates its own competitive advantages.
And, when you look at businesses, lifestyle versus growth, I see, on our side, a lot of businesses that the owner is not putting the profits or the income that they're accruing, they're not putting it back into the business, right? They're filling their own pockets. And right, wrong, or indifferent, it may not be the wrong thing, but by doing that, would you say that stunts their growth potential by taking too much out of the business too soon?
Sometimes, not always. Depends on what the requirements of the business are. In the restaurant business, you're constantly renovating and building new restaurants, and it requires, higher capital expenditures to grow. And some things like payment processing, we've looked at that, where there's very limited capital expenditures, or the capital reinvested back in the company goes to originate more customers. And so it's a different kind of capital expenditure and a different kind of need. So I think you have to look at each business differently.
And you guys don't pigeonhole as one sector. You're going to look at all businesses. And if it fits in with your models and the numbers work and you like working with the management team, is that something that let me rephrase that question. Does Cave Creek do what you guys do? Is it just focus on a certain number of industries, or are you open to any business in any industry that you think has the aspects of what would make a successful company for the long term?
Well, it has to tie to one of our partners or CEO's experience base. If you look at the 30-odd platform companies, they cover a gamut from consumer to business services to manufacturing. But there are certain areas we bring a lot of value because we don't have a deep experience base or a bench of former executives in that area to serve on boards or help us do due diligence. So we'll tend to focus on those sectors where we have that experience base. So in things like financial services or payment processing, we've got a very strong executive group. In consumer and restaurant, we happen to have a very strong group of executives. In things like distribution and logistics, route-based services, we have a really strong executive. So we can usually find out of our 50-odd executives who serve as our CEO network, somebody who's got relevant experience in the majority of the deals that come over the transom. But then you have to dive in and see how much that helps you and whether they think that particular company is going to be a winner in that industry. So we'll probably end up looking at, for every 100 deals, we might focus on 5 or 10 that have high potential for success. And that's where our background with our team and with our CEOs helps us.
And you look at the industry from your side over the last 2 decades, the evolution, and you had mentioned earlier that more and more companies are staying private. A lot of the rules, regulation, bureaucracy has shifted it from, hey, we're going to go public to let's keep it private. And with that, the competition is there just 5, 6 years ago, we didn't really have a secondary market for individuals that were accredited to go out there and get into these companies at the initial stages, right? And that evolution itself, I'm sure it makes your job even harder because you've got a lot of people out there that are just throwing money around that don't really know what they're doing, and they're not going to help guide the company. It's more of utilizing the internal basics of keeping that public market out of it and allowing only a set number of people to get in and invest. Where do you see the evolution of things going over the next decade in regards to your business?
Well, it's interesting because you got two forces pulling at you. What you said is the huge increase in the number of investors has created a lot of investor groups or even individual investors that are trying to invest in areas they just don't know. And as people reach for yield and reach for return, and their capital greatly outstrips the supply of deals, we see a lot of what I would call illogical investments, where the downside is huge and the upside isn't that great. But that's the function of where we are in the capital markets today in terms of the oversupply of capital. So then that gets to, what does it take to make a quality investment, a quality company? And a lot of institutions have developed a real strong background in industry. So the really, really strong private equity firms have industry verticals where they invest a great deal of time and energy with executive roundtables and partners with deep experience in those industries, whether it be chemicals or whether it be restaurants, all areas that require a good expertise. They're actually burrowing deeper and deeper into that industry and focusing more and more and specializing more and more. And that's the only issue there is you can know an industry real well, but very few have a breadth of an industry groups that give you diversity in your portfolio. So it's up to the individual investor or the pension fund to try to pick their own sort of group of managers that can access a diverse enough group of businesses. And this goes on to the whole economy. What's happening is the growth segments are narrowing. So there's a lot of companies that you can invest in that won't grow much. And there's a really small number of companies that are really growing rapidly. But you're overpaying wildly for those if you get anything wrong. So if you're getting double-digit growth, but they're charging you double-digit multiples, you can't be wrong. So it's creating a lot of pressure on the industry to do due diligence. It's actually increasing deal mortality. So you sign up for a deal, and if diligence goes slightly wrong, the deals collapse. So we're seeing a very high percentage of deals that get started and that don't get finished because of it's the pressure on companies to achieve perfection in their growth plan.
Right. And you see this the last, 8-9 years since the Great Recession. I mean, we're just awash with capital, right? There's just money that is out there that needs to be put to work. So you had talked earlier about you've got this segment of people that are investing that really don't know the industry. And I guess I would liken it to the amateur coming into the poker table in Vegas with the professionals, and those guys licking their chops saying, we're going to take advantage of this person. So I'm sure that, more of that probably happens on the angel investor side, but even in your business, as you're getting a lot of people into the private equity, the venture capital business that maybe doesn't have the experience and the expertise, but they've got the capital, they're going to have a hard time making things work, especially when things start shifting, with the economy itself. With this expansion is one of the longest we've had in our history. And, at some point it's going to shift, and it's who can pivot and who's built the structure in place to be able to weather that storm. But when things are good, people forget that they can go sour. And that's where probably people that know what they're doing and firms that know what they're doing, that's where you guys can shine.
Well, we like to think so. And, we've slowed our investment pace last few years as that's occurred. But obviously, you can work around that. If you have a proprietary introduction to a company that wants a highly structured transaction that doesn't really want to sell, they just want to sell part of their company and get some liquidity. So they're not trying to auction the company and then go away to the beach. I think those are the kind of companies that, may not be quite as frothy of a valuation. Everything's going to be a full valuation today, but those are going to be less frothy and less prone to risk of loss than an auction. So, but I would agree that there's a little bit of the poker table analogy you used, where, oh gee, if I don't know who the sucker is, it's me. That there's and that's what everyone says in the auction. These investment bankers, the Silverton devils, they're like, oh gee, you won this auction. And then these private equity friends of mine go, oh my God, I won. What did I do wrong? Because I just outbid a lot of other smart people who bid less than I did. So there's a real fear factor of screwing up. And I can give you my 25-year perspective on valuations and why people bid what they do. But what the story you hear a lot is that these large funds have to put the money to work. They have 3 to 5 years. So they're just shoveling it out the door, even if they know they're going to make not such a great return. And they're taking more risk than they would like, because if they don't use it, they lose it. And that's a real factor in our industry right now.
And where do you think with where the industry is right now, or just the economic factors, both U.S. and globally, where are you in that mindset of where we are in the stages of this cycle?
Well, we're certainly late in the cycle, maybe later than late. I would say that it's not quite 2007 in the housing market, but I often think so. If interest rates go up just 1 or 2 percentage points, you're going to have a very difficult time for a number of these leveraged transactions that were done in the double digits. So the company's growth rates, were not great in some cases. They were okay, and they had to grow out of their debt. But if you suddenly layer on another couple hundred basis points on the interest front, you're going to see a lot of trouble. And so we try to keep our leverage down and our valuations down in the single digits. And even then, it's hard. Even then, you've got battles, customers, competitors. But you layer on financial risk with operating risk, with competitive risk, I think that's too much risk. And I think we're going to find out in the future, maybe sooner rather than later, where the problems were. And as Warren Buffett said, who is swimming without a bathing suit? And when the tide goes out, you find out.
Right. I love it. And I mean, are you seeing your deals? You said you guys are not, using leverage to that extent, but are you seeing now more and more of the deals out there that are being done? Are they using more leverage than we've seen in the past to get to some of those levels there, that if anything happens wrong, that they're just not going to be able to repay their debt?
Well, yes, but there's a number of caveats to that. There's a lot of leverage out there, and what's happened, essentially the lenders at that high end have become pretty sophisticated, so they're happy taking over a company if something goes wrong. So essentially, it's just you have what I would call an uncertain ownership structure. If you get into a deal, you sell it 12 times, you leverage 6 times, put 6 times in, which in private equity world would be considered reasonable leverage. But if anything goes wrong, the people who own the debt could easily step in and use their covenant structure to do what they call loan to own. And that's become pretty popular. These aggressive lenders will lend aggressively, but they'll have triggers and structural benefits to make sure that they get their money back, even if it means crushing the shareholders. That's, I'm not making a value judgment, but that's the market. That's the way you're going to take that risk. That's the downside.
And I'm sure a lot of business owners sometimes maybe don't even realize what they're getting into in that scope, especially if they're working with some firms that are more aggressive and maybe don't fully understand the realm of that deal and how it can come back to take everything that they've worked so hard for.
Yeah, I mean, I think you're correct. There is a lot of downside to excessive leverage. I would stress, though, that the majority of the what I call middle market buyout groups are in the smaller end where we occupy are really, really focusing on partnership, on focusing on growth. And if they run into bumps, they're very, very good to work with. There's not an issue of taking control or anything of that nature. Most, there's a group of what I would call hardcore distressed investors that get a lot of the headlines like Cerberus, but the reality is most people don't want to take over a company. Most people want to let the management team work it out. And it's hard. They know it's hard, and they want to support their team. The only time in 25 plus years of investing and working on these deals where I've seen an actual management replacement in our group is where there's been fraud. That you've had to move some things around, but where there's just real negligence or fraud that is unmistakable. That's when you'll see that's when they exercise their rights. But again, I like to focus on the growth because the majority of these companies are growing, and if they're good enough to make the cut and they're in the top 10% of companies in that category, you're going to likely see them be successful. The majority of companies are very strong, and that's why the private equity market exists, to winnow the winners from the losers in this in this market.
And when you go into a deal, when you're weighing things out, what is there an optimal time that you want to be in that deal as the investor and capital and the guidance?
Those used to be an estimate of 5 years, because that was very commonly embedded in the pension fund documents backing most of the private equity firms. But the reality is now that that period is stretching out. And that's one of the reasons that we believe that the traditional 10-year blind pool fund is breaking down as a structure that's useful to entrepreneurs, where you have to be in and out in 5 years. You have to raise your next fund, in 5 to 7 years. You're constantly pushed to accelerate the velocity of money, regardless of what the needs of the portfolio companies are. So we're seeing more and more changes to private equity firms that I think are beneficial to the entrepreneur. They're stretching out investment horizons. They're lowering the fees. They're creating more accountability in most cases in the private equity investors. So the entrepreneurial environment, I think, is much more likely to thrive in an environment where you're not forced to sell every 5 years. And that's a big pitch for us. Because most of our capital is personal capital from ourselves and our CEOs, we don't have to sell at a particular time. And founders love the fact that we don't have to flip, and we can hold. We've had one company for 10 years. We're still holding it. So we're not there to push out returns so we can raise a giant fund. We're there to grow our capital, and a lot of that capital is our personal capital.
And you think about private equity, and I know it's come a long way, but you think back to the 80s and 90s, the liar's poker and all the negative press. And I'm sure that's still something that you have to compete with, right? Of why we're not like that, and that transparency, and maybe the fee compression. It's probably a good thing for you, right? That it helps to shape the industry of what you guys really do versus the private equity that's coming in like the vampire and just trying to get everything out of that company and then move on to the next one.
Oh yeah. We've got a long way to go to repair our public reputation as an industry. Some of that was justified, and I think a lot of these issues really surfaced when the industry mushroomed in size. And you hear stories about the $5 million birthday parties and the multi-million-dollar paydays, despite no good returns. And it's obviously gotten a lot of negative press. It was unjustified as well. But the structure of the industry is creating, I think, a better environment today for entrepreneurs as they've adapted to these changes. But boy, ever since the Mitt Romney run in 2012, where they dredged up all these stories, a lot of which were actually fictitious, they were taking and misconstruing some issues that created, in my view, a very distorted picture. There was as much or more good news that could have come out of that. And the industry's done a poor job of describing how it adds value in the public press. But I can tell you that as it's gotten bigger, it's real hard to stay entrepreneurial. And that's a choice every fund makes. We've made the choice to stay under $100 million transaction size for most of our deals. But the industry's gotten to the point at $2 or $3 trillion that they're focusing on much larger deals. 93% of all private equity is now managed in billion-dollar funds and bigger. So culturally, it's changing just due to size.
And trying to change that image and so forth is. I wanted to talk to you a little bit about the show that you have coming out. So you've got just like I do the podcast, we want to disseminate good information out there to listeners that are growth focused and wanting to build the right practice. So walk us through why you're starting the radio show, Cracking the Private Equity Code, what it entails, and how we as the listeners can tune into it.
Sure. I was approached by a network to start a show on private equity because, shockingly enough, there is no show on private equity. You look at the news media, there's tons of shows on everything from real estate to public stock investing, and there's nothing in private equity. So I thought it'd be kind of intriguing to do that. And so we started just beginning our recording last week. It's every Wednesday at 10 a.m. on Voice America. And what we do is interview entrepreneurs who want to raise capital or who did raise capital and hear their story, hear why it why they were successful. And I think one of the things that, caused me to say yes when they approached me was just the amazing amount of misinformation that's in the private equity market. People were given wildly different stories about what their company was worth, or what they had to do to get capital, or what their bank was going to force them to do. And I was surprised that here we had a multi-trillion-dollar market globally, and yet the owner of a $50 million or $100 million business was not getting any guidance, any objective sense of what structure and terms would be. Some of the investment bankers were very good, and some of them were not so good. In fact, some of them weren't even investment bankers, but purported to be, and were happy to deliver advice at the country club to these business owners. And so they were coming in with just amazing amounts of misinformation about what they should do with their company, or what was required to get a bank loan, or things that in my view are vital if you're going to succeed as a business. So I thought this would be a good forum to begin the discussion of what is it that it takes to be a successful company backed by private equity. So our first episode next week is our private equity do's and don'ts, and we're hosting one of our mezzanine debt partners, C3 Capital, along with one of our collective investments. In their portfolio, they backed a very interesting fellow in the restaurant business in his new venture. His name is Jeff Mastro, who founded the original Mastro's chain here in Arizona. So I'm excited to talk to people who have been successful and are doing it again. And it's a lot of fun to hear their story.
Yeah, I think hearing the stories of those that have made it and those that maybe had some struggles. Same thing on our podcast here, bringing people in that are great at what they do and learning from them. And I think you'll learn a lot as well, bringing these people on. So so we can listen to it when it's going to be on Voice America. If I'm a listener, how will I get to tune into this? Is it only a live show, or is it also going to be recorded and I can hear it after you have the interviews?
Oh, it'll be both. It's going to be live and recorded, but it will air on the business channel, voiceamerica.com, 10 a.m. every Wednesday. So starting next week.
Awesome. Yeah. And I'm very eager to hear your interview with Jeff Mastro. I mean, those that are out here in Scottsdale and Phoenix, it's been a staple out here of how they've grown that company, how they sold it. And then it sounds like, reinventing after time to take what he did really well and to do it again.
Yeah, we're excited. And, each week we'll feature a different entrepreneur, and some will be pretty and some won't be so pretty. So we'll see where it goes.
I like the non-pretty are those are some of the best, right? For us to learn why it failed. So in the show notes, listeners, we're going to have on there the way for you to be able to listen to Kevin's show, Cracking the Private Equity Code, as well as a way to get a hold of Cave Creek Capital if you have questions in regards to the business structure, some of long-term goals, investment options, those type of things that Kevin and his team can definitely help with, and see if it's potentially a fit to guide you, or at least through your network of relationships throughout the country to be able to position you to somebody that may be more beneficial in that relationship. So, I think, Kevin, we could be, a 3-hour show here digging in. We could dig in on what mezzanine debt is and get into really to the weeds on all kinds of stuff. But, I think we covered a lot on the high level today of what different businesses look like in the stages and how the funding works, and really what a private equity firm and venture capital can do to not just raise the money, but to take your business to the next level. So overall businesses, and some of you may be in that early stage and some of the late stage, the key is just to understand what your goals are. And as Kevin mentioned, align yourself and make sure that you have the right talent in-house, and do everything you can as a culture to keep those individuals, whether that be through the work culture or providing on top of that awards, bonuses, compensation that's going to allow you to keep those that are going to help you get to the next level. Because business owners, you own 100%, great. But what if you owned a little less and you had the right people to help take you to that next level? To me, I think that's the way to go.
Well, great. Thank you, Andrew, and appreciate the opportunity to talk to you.
Kevin, it's been great. Looking forward to catching up soon. Have a wonderful day, and tune in later this month for another episode of Your Wealth and Beyond. Have a great day, listeners. Thank you for joining me for today's episode of Your Wealth and Beyond. To get access to all the resources mentioned during today's podcast, please visit baintree.com/podcast. And be sure to tune in later this month for another episode of Your Wealth and Beyond.
Investment advice is offered through Baintree Wealth Advisors, LLC, a registered investment advisor. Insurance and annuity products are offered separately through Baintree Planning Group, LLC. Baintree is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. You should talk to a qualified professional before making any decisions about your personal situation.